have Paul Scheininger, Jason Dowell, Nikki Falconberry from management. So the first item on our agenda is the approval of minutes. Those minutes should have been emailed out to everyone. Do we have any questions or correction on the minutes?
I have a correction to correct the spelling of your name, Fred, on the minutes, please.
Okay. Any other corrections, questions, comments?
I'm listed as others present instead of employee representative.
Okay. Hearing nothing else, do we have a motion to approve the minutes?
So moved.
Have a second?
Second.
All in favor? Anyone opposed? All right, that carries. Next item on our agenda is our fund performance report from Mariner Wealth Advisors. Eric and Michael, take it away.
Thank you, Mr. Combs. Yes, thank you very much for having us here this morning. I'll say up front, our fearless leader Pam sends her regrets for not being able to be in attendance today, but Michael and I are thrilled to be here. So as a reintroduction, my name is Eric Toll. I'm Senior Wealth Advisor at Mariner, based out of our Louisville office. Michael Gosney here is with me as well, also Senior Wealth Advisor out of our Louisville office. I'm going to start with a brief recap of the firm overall, our local presence, as well as the investment policy statement. Michael will run you through the individual fund performance or your portfolio performance, and then I'll wrap up with a economic and market overview. So, as we look at Mariner as a whole, we are continuing to grow as an organization. As a firm, we are roughly a $225 billion independent fiduciary asset manager, an RIA. We are actually in the process of potentially in the next couple of months at least adding a Lexington office as well, so we're excited about that. But the resources that we add, that we continue to bring to bear, really only matter in terms of the point that we are improving the experience for our clients, such as Lextran. We are obviously nationally located. This really helps us in that when situations arise that we're not used to dealing with, we can reach out across the country to various branches, and it's very hard to find an experience that somebody else hasn't had that we can draw upon. So we have now over 100 individual branch locations or office locations. That does not even include for example, the potential startup that we'll have here in Lexington. So those are our significant national footprint. It really does come down to how we deliver locally, and this is a snapshot on page 4 of our local team. Again, Pam is our managing director and leader of our market. She is, and our team is the top-ranked RIA in the state, and we're very proud of that. We also have on our group of 15 Mark Metcalf, who advises us on tax issues, so that we can maintain a full breast of anything that might impact our clients from a taxable standpoint. Mark's office is just a couple of offices down from mine, so it's nice to be able to not have to be the tax expert in the office and have somebody of his quality there to tap into. But as we move on page 5 to the Lextran pension plan, we'll just briefly detail the executive summary of the investment policy statement. We are targeting roughly a 5% cash position with a range of 0 to 10%, roughly a 35% bond position with a range of 20 to 50%, and a 60% stock or equity position with a range of 50 to 80%. So in short, what you're looking at is your traditional moderate 60-40 portfolio between stocks, bonds. Cash typically falls into that category. Some specific restrictions to your plan, that no individual size will be more than 5% of the portfolio in order to maintain and guarantee a level of diversification. The maximum international exposure, including mutual funds and ADRs, is 25%, and the maximum investment in small company mutual funds is 10%. So the design of the investment policy statement is to look at large, primarily domestic equities to invest in. From a fixed income or bond standpoint, individual bonds must be investment grade, which is a BBB rating or higher. And any bonds below that can be held within a mutual fund, so we're not holding any individual speculative bonds in the portfolio, or cannot and don't. And such funds may not exceed more than 5% of the market value of the portfolio. As I said, this is a textbook definition, 60-40 portfolio, moderate allocation with specific restrictions to make sure that we're not straying into anything below investment grade on the fixed income scale, and keeping our eyes fixed higher on the large, more established companies in the equity universe. As such, our benchmarks reflect that guidance. So our benchmark for stocks is the S&P 500, broad large cap index. For international equities, it is the MSCI EAFE index, which again is your large cap international index. And our benchmark for fixed income is the Merrill Lynch 1 to 10 year government and corporate bond index, which is what the GC stands for. So with that, I will transition over to Michael to discuss the overall market and pension plans performance within that market.
And if you flip the tab, your statement document is just before that. So flipping through those 10 or so pages will get us right where we need to be. So we always like to recap the prior year before, just to look at the major indexes to see how the market performed. In 2023 was a very positive year on all indexes, and really it was a reversion back to the mean from 2022. 2022, we had higher interest rate policy, which really stocks and bonds went down, they declined. So 2023 was somewhat of a reversion back to the mean. Looking at 2024, on the next page, we have it through April of this year. The first quarter through March was very strong, very positive. We basically matched where we thought the year-end target performance would be on the S&P 500. Had a little bit of a pullback in April. So far, May is relatively positive. Whatever wood is around here to keep that up for the rest of the year. But you can see the S&P 500 in green is the best performer of the indexes. The Russell 2000 is a small cap index. It's down about 2% so far through April of this year. But this just gives us kind of a gauge and a reference as to the overall markets and portfolio diversification, because we're not just in one of these asset classes. We're essentially in all of them, and that's portfolio diversification in a nutshell. The next page, we talk about the S&P 500, and the S&P 500 has evolved over the last handful of years. It has become more and more and more tech-weighted. And what that has done is because the S&P is a market cap weighted index, the largest companies make up the largest percentage of the S&P. So for reference, Microsoft is 7% of the S&P 500. We don't hold 7% of Microsoft in the portfolio. So it's not really it's a good gauge and a good benchmark. It's the normal benchmark for an equity portfolio. But this is really looking at how the Magnificent Seven, which is a term that was coined for the 7 largest companies within the index, and they're all essentially tech companies. So if you just own the Magnificent Seven, you had a great year in 2021, a bad year in 2022, a great year in 2023, and a pretty good year so far this year. You're not getting portfolio diversification though, and you're taking a lot more risk. If you didn't own any of those companies though, you underperformed. You still had a pretty good year in 21, not as bad 22, and so on and so forth. Looking at the S&P, you can kind of see it's in the middle of both of those. So we still want technology exposure. In a couple pages, we have a slide that shows the equity exposure or the sector exposures. But this is just to show you that there's divergence between the top 7 and the rest of the 493, when you look at an average stock. So just to paint that picture, and of course, if anybody has questions, ask. On the next page, we look at bonds, bond interest rates, and we look at the yield curve. Starting from the bottom and going up, this is the yield curve from January 1st of 2022. This is what's called a normal yield curve. So it's upward sloping. The longer out you go, hopefully the more premium you get for holding a bond of longer maturity. In 2023, you can see interest rates shot up. Like I mentioned before, 2022, we had interest rates gradually increasing quite a bit to combat inflation. So we've seen interest rates rise very quickly in 2020, between 2022 and 2023. This line, the green line, is in what's called an inverted yield curve. And so basically your shorter term bonds are paying a higher interest rate. We can see that for April of this year as well. We're just seeing a little bit of a higher rate. And essentially what the market is doing is it's saying, well, if you own a longer term bond, your hope is that in whatever period that is, let's say 10 years out, 4.7%, in 10 years, you're assuming that interest rates will be lower than 4.7%. So that's why you would buy a 10-year bond today. So the market is basically saying this is going to change, and we expect to see more of a normal yield curve once the Fed starts reducing interest rates as inflation, that picture continues to unfold. So we should probably start seeing interest rate cuts within the next 12 to 18 months, depending on economic performance. A lot of that's been relatively fluid over the last quarter. Market was expecting about 6 rate cuts. That got cut to 3. Now we might be looking at 1 or probably just 1 or 0. So the next page, page 21, looks at your portfolio. And starting on the left side, we break down the various asset classes, your large, mid, and small cap, and international. Those are your total equity exposure, and that's at 71%. And it's within the ranges that Eric had mentioned before. Your equity exposure target is 60, but we can work anywhere between 50 and 80 as we see and deem fit for the portfolio. The fixed income and cash is the remainder of the 29%. Performance-wise, so far year to date, the portfolio has performed through April 3.5%, and that's just over 0.2% on fixed income. Of course, a lot of times you have to wait for the full year for interest to different bonds pay different schedules. So we're basically collecting rent or collecting income, and then the equities are at 5.1%. And then you can see 2023, the stark difference. We had a 20.9% increase in the portfolio in 2023, but a 12.4% loss in 2022. So it just shows the difference between what's happening in the stock market and how that evolves to the portfolio. The thing we like to focus on, though, is the long-term returns. So at the far right, you can see the 10-year numbers averaging 7.6% a year. Markets don't move in straight lines, but that's a really solid number over the last 10 years. You can see the breakdown of fixed income and equities as well. On the next page, this really just breaks down the activity in the portfolio, your beginning value, what goes in, comes out, contributions, distributions, income that pays in, and then of course your stock market value increase or decrease, so capital appreciation to get your ending. So this is essentially just an accounting for the last 3 years. So you can see the drastic changes year over year because of the positive and negative years. Now when we drill down into the individual portfolio, On the next page, these are the individual equities that we own in our actively managed strategy. So we have active investments in individual stocks, and we have passive, and the passive will come in a couple slides. So your active investments are 69% of all the stocks that are the equities that we own. And you can see we have them broken into 3 different categories. Your far left is our growth in income. These are higher dividend payers or higher dividend growers. These companies are typically your steady eddies. They are less volatile as measured by beta. So a beta of 1 means you match the S&P in volatility. If it's below that, the S&P may go up 10%, that stock may go up 9% or 8%, depending on what the beta is. Your cyclical growth, these companies ebb and flow with the economic cycle. They're more opportunistic, so we will be in and out of these positions a little bit quicker than your growth and income types of positions. And then, of course, your high growth. We see a lot more names here, but that doesn't necessarily mean that it's a much larger percentage of the portfolio. It is a higher growth tilt, but we own smaller position sizes typically in most of these companies. There are a few bigger ones, your Apples, things like that, but NVIDIA, but those have had really good performance over the years. We're looking for more capital appreciation to grow the portfolio. And as we've talked in meetings prior, and for those I haven't met, this is where we can kind of move from high growth to cyclical to growth and income as we see things change in the economic cycle. So this is not just this is the portfolio and that's it. Our active managers are constantly researching and saying, well, what's going to fit in here? What's going to fit in here? And how should we transition the portfolio to best suit the needs of the portfolio? The next page shows the top 10 equity holdings, and these are the top 3 are technology, but we also have other companies within the top 10, which is nice. We've had really good growth out of most of these companies, if not all of them actually, depending on the holding period. But it's not just technology weighted like the S&P 500. The top 10 holdings, the vast majority of them are technology. Yours are more diversified. So as you can see, NVIDIA is up 5%, almost 5% of the total of the equity portfolio, and so on and so forth. Now, when we look at the individual positions, like I mentioned, we're diversified within the top 10, but we're also diversified within the entire portfolio. So on the next page, it really just gives a breakdown of how we're weighted, and this is close relative to the S&P 500 within 5% or so in each sector. So we don't just want to be tech weighted, but the S&P 500 has a tech benchmark of about 28-29%. We're at about 27%. That's relatively normal to be a few percentage points above or below. And then you can see the various sector allocations that kind of go along with that. Are there any questions so far? Okay, just check. So we talked about the active holdings. Now let's look into passive. And our passive holdings are ETFs, which are exchange traded funds. These are very low cost funds, and it gives us broader diversification. The active management of the stocks, we have about 45 to 55 different positions that we'll be in and out of. The passive investments, there are about 1,000 different, depending on the index. The Russell 2000 is 2,000, so on and so forth. But this chart shows the breakdown of what we have invested in large cap growth, value. Russell 2000 is our mid and small cap, and then the MSCI EAFE is the international index. And you can kind of gauge the performance relative to the benchmark below each of the funds. And again, the purpose of having ETFs is, there's just broadening diversification. get the best of both worlds with active and passive management. And we do that with a lot of portfolios, and it tends to work out very nicely. And then the last page that I'll cover is our bond review. And really, like I mentioned before, as interest rates are higher on the short end, the vast majority of the bonds that we own are within 4 to 5 years. We have a lot coming due so far this year. You can see below 2024, we have $1.25 million that's coming due. What this allows us to do is once these bonds come due, they mature and they turn to cash. And then what do we do with that cash? We're going to reinvest in something at a higher interest rate. So this is a really great opportunity to have bonds maturing so that we can redeploy that capital into something that is a higher interest bearing vehicle. And then we're locking in those rates. Again, we try to stay short term. Some of these, 2049, 2099, those are preferred securities. They're perpetually preferred, which is a hybrid between stocks and bonds. And really you can get a little bit more yield, but we have such a small percentage of your portfolio in that, and they're also investment grade rated as well. Anything else? Any questions? Okay. All right. I will yield my time back to Eric.
I think a couple of the things that the pieces that line up. If you look at the overall S&P performance and the performance of the heaviest weight relative to how we're positioned. For example, as Michael said, we have Microsoft, and as a 3.5% position, that's a healthy position within our portfolio. It's also roughly half the position of the S&P 500. So where you see names that look an awful lot like the biggest names, that is true, but in the weightings that we hold them makes a significant difference in performance. And performance is measured not just by the straight line upside capture performance, but also how we manage the volatility. Right now, of that Magnificent Seven, 4 of them are positive and 3 of them are negative for the year. So they're not necessarily all magnificent, but and that is really what goes into our portfolio construction for you. That we're looking at not just the names or being a closet index within our active portfolio. It is making sure that we're holding the representation and getting the performance, but also managing through the volatility, which is why you see the performance cycle of 20, 21, 22, and 23, and the ups and downs, where we're smoothing through that ride, still delivering performance, but not necessarily giving the same volatile experience that you would see if you were just necessarily in the S&P 500. If we look at the next tab, I'll go through the overall economic and market situation as we stand currently. On page 29 is a reflection of GDP. What I like to call this chart is snapline. Somebody snapped the long-term trend growth at 2%. Snapped a chalk line, and what you are witnessing is through the various ups and downs, through the various peaks, through the COVID debacle on GDP, our economic output just comes back to the mean line, and we're right back on that long-term 2% trend. We have a very durable economy that can weather a lot of storms. In the short term, we certainly feel it, but in the long term, we continue to gravitate back towards the long-term trend. Why is a unique function of how we produce economic growth in this country. We are a consumer-driven economy, and roughly 68% of economic activity is driven by the U.S. consumer, and let's face it, we like to do a lot of consuming. So we continue to move forward, and it gives us great hope for continued economic growth because we don't see the economy slowing down. One of our top holdings you see is Visa. I highlighted this last time. I love Visa, not because I have anything necessarily for them personally, but they're a great tracker. Everything that gets done in this country, Visa knows about, and they continue to tell us that the consumer is still consuming, so we feel good about the overall economy. The second largest part of GDP is government spending. Show of hands, anybody who thinks that government spending is going to rapidly decline anytime soon? Okay, so the two largest contributors to economic growth are our consumption, which is unabated, and government spending, which is also unabated. That's roughly 80% of GDP. Throw in a couple of other smaller categories and you get the total, but we do see continued economic growth as we move forward. But on page 30, I get the number, yep, we start to get into the boogeyman of inflation. The nice thing about what we're seeing with inflation is that it is absolutely subsiding. From where we sit today relative to 12 months ago, we are at half the inflation number. We've cut inflation by a little more than half, sitting on roughly 3.5% inflation, depending on how we measure it. Now that is still higher than what we would like it. The 2% target is still the 2% target, and Chair Powell has reiterated the fact that they are committed to getting it down to 2%. That last 1.5% is going to be the tricky part, and I'll come to that in a little bit. What we've seen as inflation has reduced dramatically from its peak of over 9% not that long ago, and supply chain issues started to sort themselves out and started to reduce pressure on prices. That work has largely been done, and now we have the harder work of actually wrangling the rest of inflation out of the system. And again, I'll come from some of those components, but the thing to bear in mind, the important thing to remember is that what we care about from an investment standpoint is the trend. The trend signals to us where the rest of economic conditions are going. It signals to us what regulators and the Fed is likely to do, and as long as the trend is in the right direction, then we feel positive for the overall accommodative nature of the market. The next page, page 31, breaks down the components of inflation. On the left side, you have what's known as headline inflation, which is really all the things. They include energy, core goods, the things you have to buy, food at home, which I pointed out in the last meeting. If you want to beat inflation, eat at home. Food at home is flat to negative. Eating out, if you go to Applebee's, you're paying about 30% more now than you were 18 months ago. So don't eat at Applebee's, I think is the lesson there. Shelter, dining, recreation, and auto insurance. Now I want to the auto insurance, I didn't do this chart, but I'm glad that they did it in red. It'll make it easier for us to keep our eye on. That inflation rate is coming in at 3.5%. That is right now is basically a stagnant rate. Some of the components like core goods are actually shrinking. We actually did see energy shrink a little bit through the middle of last year. That took some of the boiler off, again, supply chain, took some of the steam off of inflation. And one of the persistent areas that we still deal with is shelter, and I'll address shelter here in a moment as well. What the Fed tends to look at is the chart on the right, and that is contribution to core services ex shelter. And the reason why they strip out shelter and energy, by the way, is because those tend to be volatile categories that they can't do anything about, so they just kind of take it off and say we're going to measure by something else. But the one thing, and remember I told you to keep your eye on the red, the one thing that has really boosted inflation has been auto insurance. I have children in their 20s, and I can attest to the auto insurance component. Fortunately, I don't pay for it because they're in their 20s. But items like that are a little harder for the Fed and for central bankers to squeeze out. Just raising interest rates doesn't minimize your need to drive and to insure that car by law. So that's going to be a little bit more problematic to see some of these areas. So we're probably going to see a little higher inflation rate with us as broadcast than what we are, than what we want and what we're used to. That's going to be a little stickier than what we would like. But the overall trend for the majority of inflationary services is coming down, and that's a positive for us from an investment standpoint.
Question.
Yes.
So on the right graph, page 31.
Yes.
I'm noticing, so 0%, and that's the average or the starting point, or what do you call the 0%?
Right, so think of it, inflation is growth, right? So it's year-over-year growth. And what you are looking at is the various components of inflation relative to zero. So anything below zero is actually shrinking in price. We don't see that a lot.
Medical is shrinking.
Medical actually, relative to where it was, medical devices specifically are shrinking.
Okay.
And part of that is a function of, I've got 55 chickens, we produce a lot of eggs.
Right.
Unfortunately, we don't sell them. Because if you see the price of eggs, it goes to, let's say, $5 a dozen, right? Well, when inflation tapers off and gets to normal, it doesn't go to $4 a dozen. At least I've never seen that. But there are some things where pricing pressures, where competition will actually wind up reducing the price. And what we've seen, particularly in medical devices, is that the cost of devices because of competition is actually reduced. So what used to cost $100,000 now costs $90,000, that type of thing. So you do see those reductions. Again, my challenge is in auto insurance, whatever you're paying now, I don't see that being like 10% less going down. We just want to make sure that that levels off, because the rate of growth, which is what we really worry about, which is why inflation is so problematic, is that it's growth. It's not, this is where the price is, and it just levels there. And so that's the challenge. Same with shelter. Again, I know I mentioned this last time. Shelter is so tough, because how do you measure rent? And the Byzantine manner in which they calculate shelter, owner's equivalent rent. If anybody can explain that one to me, and I've got my background's in economics, I have no idea how you come up with owner's equivalent rent in any way that really reflects what the on-the-spot cost of shelter is. That could already be below 2%. We don't know, because it's such a lagging measure, but right now that is reflecting an upward pressure in inflation. So it might actually be lower than 3.5%. I would argue it probably is. Or 4.7, I would argue it probably is, but again, the numbers are what the numbers are, and that's how they're basing their ongoing decisions. Okay. Did I answer your question, Jason?
Yes.
Okay.
Yes.
Probably, and then some. Regretting asking the question.
It's all good. It's all good.
The next page 32, is another big part of inflation. Inflation really does come down to too much, or a quantity of money chasing a quantity of goods, and a large part of that money is driven through, if not the overwhelming majority of that, is driven through wages. Labor market fundamentals play an important part in inflation. When we are paying above productivity, that gap gets filled by higher prices. It's a market regulating function. It's not good or bad, it just is what it is. And so, as we've seen, what I tend to look at is the chart on the top right, which is the quits rate. That's the number of people who leave their job voluntarily because they're going to get paid more someplace else, or their existing employer is going to pay them more in order to keep them. That is the number that we look at. Now, we all want that to be high for our own personal reasons and just for our fellow man. On the other hand, it also tends to be very inflationary when it gets out of cycle. It also tends to reduce productivity, because when people leave jobs, there's a gap in terms of their efficiency when they go to the next job coming up to speed and getting really good at it. Well, you all understand that. So what we certainly want to see a quits rate. We don't want to see everybody stuck, but we don't want to see it too high. And so to start to see that normalize is a positive when it comes to an inflation measure, which brings us to page 33, which is the idea, how many rate cuts. Michael mentioned this at the beginning of the year. The market thought we were going to see 6 rate cuts this year. Not sure exactly what the market was looking at. We thought there was likely to be 3 rate cuts this year. The way inflation numbers have come in, the odds are, if there are any cuts at all this year, it will be at the end of the year. But the good news is we don't need rate cuts. And we're here from an investment standpoint. The market has not suffered because rates have been north of 5%, because the 10-year is at 475 or 460, wherever it is exactly today. Because having rates that high, you cut when you need to juice the economy. When the economy is moving at a solid pace, you don't need to reduce interest rates. So a reduction in interest rates would suggest that we need to help move the economy forward. The good news is we don't need rate cuts. The economy is moving forward. So just to do something in order to, in order to signal for the market, we don't want to run the economy for the benefit of the market, even though that's my livelihood, so if you wanted to. So what we're looking at is likely, if there's any cuts, it'll be towards the end of the year. My personal guess is we will probably not see a cut this year, and that'll be fine. We'll all survive, and investments will do quite well. By the way, long-term rate on the 10-year is 5%. We're actually trending below historical averages on the 10-year treasury. So we're not out of some kind of phase, just out of our recent history. And then the last, and I would argue the most important page in terms of expectation setting, is the stock market annual returns and intra-year declines, meaning that what happens in the course of any given year, how far can it fall, and almost every year we see a correction. Almost every year you see at least a 10% and on average of around a 13% correction. That doesn't mean that year winds up negative, but that does mean that in the year you do see a piece of volatility. We got a sneaking suspicion April may have been our kickoff for a correction. It seems to have leveled out, so maybe not. But I would be more surprised than not if we don't see a 10% pullback. What does that mean? Well, we got to over 5,200 on the S&P 500. We're right around 5,200 right now on the S&P 500. A 10% correction, do quick math, you're looking about 520 points off of that. So you're getting into the 4,600 range in the S&P. I guarantee you as that happens, if it happens, and it likely will, people will run around with their hair on fire saying this is the end of times and oh, what are we going to do? It happens every year. Our chief investment strategist called for S&P 500 at 5,200 by the end of the year. We got there in March. I would not be surprised if we ended there at the end of the year after going down and then swinging back up again. It would be totally in line with our base case, which is a return to normal. That's a normal year. You have a correction in there, you wind up with a roughly 9%-ish or so return, and we'd be very happy if at the end of the year we could report a 9% equity market return on top of a 5% bond market return. That would make everybody in this room, that we would hit all of our objectives and be very good with that. And there is nothing that we see that suggests that we are out of phase with that path and pattern. So I will close with just some snapshots here. Again, targets for what we're looking at. Economic trends we see as neutral. Again, our overall case is this is just a return to a normal year after a yuck 22 and a yay 23. This is kind of it's a normal 24. Normal economic trends, normal to positive earnings trends. Earnings have surprised to the upside. Neutral Fed policy, neutral to positive rates, real rates, which means rates after inflation, neutral, M&A activity, neutral, credit spread. So the only thing that I would come down to here at the bottom is sentiment. Just because things are going well, if you did a poll of 1,000 people out on the streets of Lexington, I'm guessing that less than half of those 1,000 people would say things are going well. Sentiment's not awesome. Again, that can be a positive from an investment standpoint. That means not everybody's piled in, not everybody's put every last penny in. So that, from an investment standpoint, that can be a positive. And then I will close on our reiteration of our overall 2024 outlook. We expected 5,200 on the S&P as our base case, which is a 9% price return and 11% total return. I'll take it. If things go really well, we miss that correction. Maybe we wind up roughly 15% up. If we're disappointing, we wind up with a roughly flat year. Again, not awful. All in all, I think we're looking at a very productive and constructive investment environment for the Lextran pension portfolio. And with that, we are happy to field any questions that you may have, and thank you again for having us.
Does anyone have any questions? Well, thank you both for that report, and I will say, if anyone is feeling those pressures from the inflation related to auto insurance, try riding a bus.
Yeah, that's the first thing I thought of when I saw the chart. I was like, auto insurance. I wonder who would be able to relate to that.
Thank you both.
Absolutely.
Next item on our agenda is actuarial report from Osborne Carrero and Associates. Steve Osborne is here with us. Steve, take it
Thank
away.
you. Thanks for having me. You have this beige report right here. I'm going to go through about 3 or 4 pages of it. All right. And the very front of it has some beige stationery, and the first page has the results as of January 1, 2024. And let me back up and tell you what your actuary does for you. You just heard how much money you have in the fund, and I'm going to tell you how much liability you have in the fund. And then I want to compare the two and kind of give you an idea of what it's going to take to keep the plan going forward on a sound basis. So looking at the far right-hand column are the most recent results, and these again are as of the beginning of this year. And there were 347 people in the plan. Now, at the time you had 76 people drawing a monthly pension, and you're paying out monthly pensions of around $52,000 each month. You had 169 working people, and then you have a little over 100 people that were in the plan, worked for Lextran, but have left, but still have a vested pension that they can get when they reach either 62 or age 65. All right, so you got about 100 of those people. The market value at the end of the year was just over $21 million. You had just over a 20% investment return in 2023, which was really good. I hardly ever say anything good about investment managers, but 20% in 2023 was good. The only other fund I saw with 20% lost 20% the year before. So while y'all lost money in 2022, as everybody did, it wasn't, it was more in line with what everyone else did, and yet you topped everyone for 2023. The recommended contribution rate is $1.98.9, or roughly $2 an hour. Between Lextran and the participants, you're putting in $2.27 an hour. All right, so that's about almost a 30-cent cushion there, about 28 or 29 cents. You'll turn the page. The current status of the fund is really good. There is no unfunded liabilities. In fact, you're about 120% funded, or you were at the end of the year, which is, you had about $1.20 in assets for every dollar of liabilities. So your ongoing cost of almost $2 an hour is roughly the cost of the benefits that people are going to earn this year. Right? You have enough hours, you earn a benefit of $50 for the year, so it's costing about $2 an hour for that $50 to be earned. Okay. The major change since last year, again, was the investment return. It was 20.7. And at the bottom of this page and the top of the next, I think I was asked to look at what it cost to raise the benefits from $50 to $75. And what I've done at the top of page 3 is I've done a $10 increase, and that's not because I think you don't deserve $25 or anything like that. It's just that with $10, you can figure out what it costs to go $1, $2, $3, $20, $25, because it's all proportional, right? So a $10 increase in benefits would cost you $1.04 cents. And if you permit me to round that, that means it's going to cost you about 10 cents for every dollar that you want to raise the $50, okay? So if you wanted to raise it by $25, that would cost about $2.50 an hour. If you wanted to raise it by $10, that's going to cost you about $1 on the contribution rate. All right, so that's all proportional. And you do have a little bit of a cushion now where you could afford to raise it by a couple dollars. And also I want to point out, these numbers are only for people that are working, right? This does not include going back and raising people that are already retired or people that have already left Lextran that will get a benefit in the future. It's just for the 169 people that are working here. Now, if you're interested in doing something for retirees, let me know, and I'll figure that out. But I just want to make that clear. It's not raising all your current retirees. It's just the working people right now. There's a section below that entitled Areas of Risk, and every retirement plan has risk, and your main risks are your investment return, because you see in 2022 you lost 14%, in 23 you gained 20%, so that's where most of your risk is. Your secondary risk is the hours that are worked, and of course you're not paying on overtime, so I'm assuming about 320,000 hours a year, and you've actually been contributing on more than that the last couple of years. It's been more like 350 or so. But I'm just trying to be conservative on 320,000 hours. Now, you know, if you think about that, that risk is also just subject to general ridership, you know, in the county. Which of course is subject to a ton of other factors. So those are your two main areas of risk for your retirement plan. Now, the white pages are a bunch of exhibits that provide supporting information for the stuff here in this summary. I typically don't go over that with you, but I'd be glad to if you want me to. There's a summary of financial information. I don't know if you get a separate financial statement for this plan, but I put one together because I need one to calculate my numbers. You have a little bit of information about the number of people in the plan. I have in there a summary of what the plan provisions are, and then a listing of what the actuarial assumptions are. The main actuarial assumption is that the fund will earn 6%, and then I have a life expectancy table based on the current, well, actually the most recent life expectancy table that is primarily for public sector employees. Okay. So that's up to date for you guys. And I have a very modest turnover assumption. Now, I think I didn't use up my 30 minutes, but you know, I could have sent you a note that said, plan's in good shape, you know, and then that was it. But, has anybody got any questions? I mean, the plan is in good shape. I think I gave you what you need to know if you want to raise the benefit amount.
Just a little clarification. On the third page where you were talking about the 10 cents for every $1, basically what it would cost to raise it. Underneath that, you had the full retirement at 30 and out. Now, would that be 15 cents an hour on top of the
Yes.
the 10? Okay.
Yes. And in fact, so suppose you left $50 and you said, well, let's do a 30 and out. Right, that's 15 cents, okay? Then if you came back to me later and said, well, what does it cost to raise the $50? Well, with a 30 and out, raising the $50 is a little more expensive.
Right.
Okay. So if you do one of those retirements, then the 10 cents will probably be a little bit higher, maybe 11 cents or something like that.
Gotcha.
All right.
Any other questions? Anyone? Thank you, Steve.
All right, well, thanks again for having me.
Thank you.
Next item on our agenda is old business. I have none. Does anyone on the committee have any old business? Or any new business?
Just want to make a note, the next meeting is August 13th at 10 a.m.
Thank you, Nikki. Keys. Anyone else have anything? All right, I think we are adjourned. Thank you, everyone.
Thank you. Thanks.